Alrighty. So today we're going to be talking about the enhanced wheel strategy. Now I've already created a couple of videos on the wheel strategy. If you haven't watched that, you can I put a link at the top right hand corner of this video, so you can go ahead and watch that video first. But for this video, we're going to be talking about a variation of the wheel strategy, and I call this the enhanced wheel strategy. Alright, so first of all, let's have a recap on what the wheel strategy is. So basically the wheel strategy, you start off by selling a cash secured put, right? You sell it at a level which you don't mind, owning 100 shares at. So you sell the cash secured put and then you receive a premium. So let's say the market goes below your cash secured put. This is where you're going to get assigned, right? If it stays below your cash secured put at expiration, you're going to be assigned 100 shares. So now that you have 100 shares, this is where you want to go and sell your covered call. Now you can sell your covered call at the price, the same strike price as where you sold your cash secured put, or you can sell it higher. Alright, if you are able to get a premium for it, a good premium for it, or you can just simply wait for the market to go up before you sell the covered call. So with the covered call, if the price goes above the strike price for the covered call expiration, you're going to have your shares called away. So now you're going to go back to zero again, where you have no positions. And this is where you start selling the cash secured put again, and you restart the wheel strategy all over again. So this is for the traditional wheel strategy. Now, what about for the enhanced wheel strategy? Now, for the enhanced wheel strategy, instead of selling the cash secured put, we will instead be selling the put ratio spread. Now, if you don't know what a put ratio spread is, please go and watch the other videos which I've already created on this on my channel. But a very quick recap, a put ratio spread is basically where you buy one put option, all right, and then you sell two further out of the money put options. All right, now this can be 2, can be 3, can be 4, any number. For our purposes, we want to use the traditional 1:2 ratio spread. So basically what this is an embedded long put spread, and you have one additional short put, which is your cash secured put. All right, so in this case, you have an additional long put spread on top of your cash secured put, which becomes the put ratio spread. So in essence, you're using the premium which you receive from your cash secured put to go and finance the purchase of a long put spread, which is in this case what you call a bear put spread. So ideally for this, what we want is for the market to go down. So this way you will make the maximum profit on this embedded long put spread. Alright, so same thing, if the market is to go below the additional short put strike, the additional short put option, at expiration, you're going to be assigned 100 shares. So once you've got these 100 shares, instead of selling the covered call, what you will be doing is selling a covered call ratio spread. So again, I've already created a video on this. I call this the enhanced covered call strategy. If you haven't watched that, I put a link at the top right hand corner of this video. Go ahead and click there and watch that first. But very quickly, what a covered call ratio spread is simply just the opposite of a put ratio spread, right? So instead of using put options, you use call option. So you start off by, right, you have a one call option, you long one call option, and then you sell two call options that's further out of the money. So again, you have this embedded long call spread. So in this case, you want the market to go up. So same thing, we use the covered call, right? The one short call option which we sold, the premium, we use that to finance the long call spread. So in this case, it's called the bull call spread. So if the market expires, or rather is above the additional short strike, the additional short call strike expiration, this is where your shares will get called away. Again, your position is back to zero, and then you start selling the put ratio spread again. So you do this over and over again. So this is the enhanced wheel strategy. So all it basically is to change the cash secured put to a put ratio spread and change the covered call to a covered call ratio spread. Okay, so what is the difference between these two? Well, let's have a comparison. All right, so let's simulate a traditional wheel versus the enhanced wheel strategy. All right, we're going to put them side by side and see which one does better. Okay, so this is the chart of Starbucks. So let's say, for example, you want to own Starbucks. Let's say that you think that Starbucks is a good stock. You want to buy it at, let's say, $77.50. All right, so we have decided that $77.50 is a good price for us to enter. Okay, so let's compare both of them. So for the traditional wheel strategy, what we're doing is we are going to sell a cash secured put. So in this case, since we've identified that $77.50 is where we do not mind getting assigned 100 shares, so this is where you want to sell the cash secured put. So for the cash secured put, you can see we received a premium of $1.98. So there's $198 per contract. For the put ratio spread, for this put ratio spread, as you can see, we sold the long put option at $82.50, and then we sold two put options to further out the money at $77.50. So this too is the same price. So what's the difference down here is that there is this embedded long put spread, right? That is 5 points wide. That means if the market, right, let's say it goes all the way below here at expiration, you'll be able to receive the full profit of $5 on this embedded long put spread. So for this put ratio spread, you receive a much lesser credit because you have used the premium that you receive from selling the cash ticker put to finance this long put spread. So your credit which you receive will be only 24 cents, so that is $24. Alright, so let's take a look at different scenarios to see how they perform. So for scenario number 1, let's say Starbucks is above $82.50 at expiration. So for the traditional wheel, what's going to happen is that the cash ticker put is going to expire worthless, and your profit is simply the credit which you receive for selling the put option, so which is $198. Alright, so let's take a look at the enhanced wheel strategy. So for the enhanced wheel strategy, this whole put ratio spread is going to expire worthless as well. So if it expires worthless, the only profit you're going to have is just the credit which you receive for selling the put ratio spread, which is only $24. So as you can see, in this case, if the market doesn't even go below the long put option of your put ratio spread, then the cash ticker put is going to make much more money, right? So in this case, right, in hindsight, if the market is going to go up, then your cash ticker put is going to do better. By the way, if this video has been helpful so far, I'd appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. Okay, let's take a look at the next scenario. So scenario number 2 is if Starbucks is in between $82.50 and $77.50. So basically the price has entered into your long put spread, which is essentially what you want for the put ratio spread. So let's see what happens. So for the traditional wheel, the cash ticker put expires worthless as well, and again your profit is the same, right? As long as the price settles above your short put strike for the cash ticker put, then the profit you're going to receive is going to be the same regardless, right? Whether it goes very close to it or far away from it, you're just going to receive the credit at which when you first sold it. So that is $198. So what about for the enhanced wheel strategy? So for the enhanced wheel strategy, the profit is going to be very dependent on where the the price settles at expiration. So in this case, let's say the price settles at $80.25 at expiration. So that is somewhere down here. Okay, so let's say the stock settles at $80.25 at expiration. Well, your profit is going to be $199. So how you derive this profit is basically you just take the credit which you receive for selling the put ratio spread, right? Then you add on to the difference between the long put strike and where the stock price settled at for expiration. So in this case, 80.25. So you take $82.50 minus $80.25. So that's around $1.75. $1.75 plus 24 cents, you get $199. So as you can see, the profit is actually about the same, right? It's the same as the cash ticker put. So what does this mean? It means that as long as the market settles anywhere from this point to this point at expiration, the cash ticker put would actually do better, right? You would do better with the traditional wheel, because as the stock price, right, let's say it's above $80.25, that means the embedded long put spread on your put ratio spread is not going to make as much. Okay, so the only time where the put ratio spread for the enhanced wheel strategy is going to perform better is if the market goes below this point of $80.25. So anywhere from $80.25 all the way down here, your performance, or rather the profit which you're going to receive, is going to be much higher, as you can see from here. So let's say, for example, if the stock settles at $78.50, which is somewhere here, if it settles here at expiration, the profit is going to be $424 because you have taken $4 out of this 5-point wide spread, right? So from here all the way to here, you have taken $4 on your embedded long put spread. So as you can see, you make much more, double the amount, than if you were to sell the cash ticker put on the traditional wheel strategy. Now let's take a look at scenario number 3. So scenario number 3, what if Starbucks is below $77.50 at expiration? So what's going to happen? So first of all, they are both going to be exercised. So for the traditional wheel, You're going to be long 100 shares at $77.50. This is where you sold your cash secured put at. So in this case, we do not really calculate the profit per se because it's actually not in an overall profit yet, because right now you are just long the 100 shares. So for you to realize any profit, you have to close out of this position first, then you tabulate the profit. So in this case, instead of tabulating the profit, what we want to do is we calculate the break-even price. So the break-even price, you basically just calculate it by, long the price which you are long 100 shares at, and you minus off the credit which you receive, $1.98. So your break-even price is $75.52, which is somewhere around here. So what about for the enhanced wheel strategy where you're using the put ratio spread? So for the put ratio spread, you'll be exercised as well. So you'll be long 100 shares at $77.50, and then we're going to calculate the break even as well. So for the break even, as you can see, it is much lower. It's going to be at $72.26 because you have this embedded spread. The embedded long put spread has already made you $5, right? Because you had a embedded long put spread from $82.50 all the way down to this point, $77.50. This is $5 in profit. So you take this $5 in profit, you minus off the price which you went long 100 shares at, as well as the credit, right? You minus this off as well, you get $72.26. So as you can see, it is so much lower than where you would be if you just sold the cash secured put, right, for the wheel strategy. So in this case, you will be better off with the put ratio spread, right? The enhanced wheel strategy would be better because you have this added protection to the downside. With this added protection to the downside, your break even is lower, which makes it much easier for you to profit on the way up as well. So if the market settles at $75, right, at this point of time, you can either just choose to close out your long shares at 100 shares, you'll still be in profit because your break even is so much lower down here, or you can just simply sell your covered call ratio spread, right, maybe at this point, and then you have the embedded long call spread from this point to this point, right? So anything from here, you make additional again on your embedded debit spread. But whereas for your cash secured put, right now at this point, let's say for example, if it's at $75, right, then you're still going to be at a loss for your 100 shares because your break-even price is above. So in this case, you may want to wait until the market goes a little bit higher before you can sell the covered call, or maybe you can try and sell a covered call right now to see if it gives you enough premium. Okay, so this is for scenario 3. So for scenario 4, basically this is what I've just covered. This is what you're going to do if you're going to sell your covered call and your covered call ratio spread. Now I cannot simulate the order ticket to let you know how much you can receive because the price is not right now at $77.50. But I've already covered this in another video, which is called the enhanced covered call strategy, to show the comparison between the normal covered call and the enhanced covered call strategy. Alright, I also share with you the pros and cons of both. So go ahead and watch that video. Again, I'll put the link at the top right hand corner of this video so you can go ahead and watch that. Okay, so I want to talk a little bit about the mindset and psychology differences between the traditional wheel strategy and the enhanced wheel strategy, because when you put on the traditional wheel strategy compared to when you put on the enhanced wheel strategy, your psychology is going to be very different. All right, so the strategy mindset for the traditional wheel strategy is that you do not want to get assigned, right? When you sell the cash secured put, we ideally want to only collect the premium on the cash secured put. That's because the premium will be the same regardless if you get assigned or not. So let's say the current price of the stock is here. What we do is we will sell a cash secured put somewhere below the current price. So we will let's say we receive a premium of $2 for this, right? Ideally, what we want is to see that the market goes up immediately. This way, the cash secured put will lose its value and will be in profit, right? We ideally do not want it to come down and have us assigned. So if the stock actually starts going down, you will see that this cash secured put will start to increase in value, right? If it comes all the way to maybe to this point down here, right, your cash secured put may have increased to $4, which means you're seeing a $2 loss on your cash secured put. So that is why the psychology over here, right, the strategy mindset over here is that we ideally want it to immediately go up the moment we sell the cash secured put. Now this is very different from the enhanced wheel strategy when we are selling the put ratio spread, because with the put ratio spread, we actually are prepared to get assigned. We want it to go down. We want the stock to go below our short put, because that's how we can get the max profit on the bear put spread. If the market doesn't go down, then we're not going to make money on our bear put spread. And you can also make more on the cover call ratio spread than the cover call when assigned. So first of all, let's talk about this. So the put ratio spread, say this is the +1 put option, and then you have a 2 put options down here which you sell, and let's say this is where the current stock price is. Now, if the market was to go up, are you going to make more or make less? So as we have seen in the scenario 1, we actually do not make much money at all, right? We're pretty much making scratch to a little bit of money if the market goes up. Ideally, what we want is the market to go down, because in this case, if the market was to go past our short strikes, then we'll be making the full profit on our embedded long put spread, which is very different from the cash secured put. With the cash secured put, you don't want it to go down. If you sell the cash secured put and it starts going down, you start to feel, a little bit uneasy. But if the market starts going down after selling the put ratio spread, suddenly you start to feel excited, because that is where you can potentially realize the full profit of your put spread. Now, what about for the cover call ratio spread and the cover call? So it's basically just the same, but the opposite, right? For the cover call, you just receive a credit by selling the cover call, just the premium, regardless whether the market goes up or down, you're going to receive the same. But for the cover call ratio spread, because you have now a embedded long call spread from here to here, if the market was to go up past our short strike for the cover call, we will actually make much more. Alright, so let me just delete all this drawing. Let's talk about the entry psychology. So the entry psychology, basically when we enter the cash secured put for the traditional wheel strategy, we want the stock to stay above the cash secured put. So as mentioned earlier, once we sell the cash secured put, we don't want to see it come down, right? Ideally, we want the stock price from this point where we initiated the cash secured put, we want it to go up. So if the stock drops after selling the cash secured put, we could have gotten a better premium on the cash secured put. So that is why, as I mentioned earlier, if the market goes down, you could have said to yourself, I wish I could have waited, a bit longer before selling the cash secured put, because in this case, you would have gotten much more premium. But for the put ratio spread, we want it to actually go down to the bear put spread zone. So if the stock drops after selling the put ratio spread, the strategy is working. So you can see there's a difference in psychology here. If the market comes down, you're excited with the put ratio spread, not so excited with the cash secured put, right? But if the market goes up, of course, you're excited with the cash secured put, not so happy with the put ratio spread. But at least you're still making some money. You're not going to go out of the trade empty-handed. Now, what about the exit psychology? So the exit psychology is where you're already long 100 shares and then you want to get out of it with a covered call. So with the traditional wheel strategy, we want the stock to be as close as possible to the assigned price to get higher premium on the covered call. So once you're assigned, let's say for example, this is where you are long now 100 shares. If the current stock price is down here, if you were to sell the covered call at this price, right, you may not get that much of a premium compared to if you waited for the market to go slightly higher and then you sell the covered call, right? But for the covered call ratio spread, it doesn't really matter that much because you can actually adjust the strikes, right? You can adjust where you put the call spread. So for example, again down here, if you are long this 100 shares down here and the current stock price is again down here, what you could do is you can just simply sell the covered call down here. Okay, so you receive a premium for that, and then you buy the embedded long call spread. So you can choose to buy an at the money long call spread where the long call option, the +1 of the long call, will be here, and then you see how far of a spread width you can get for this embedded long call spread. So let's say for example, if you receive $2 on the credit for the cover call, you see how far can $2 get you. If it gets you all the way to here, then this is where you will be selling the additional short call option. So that means if the market was to go up just a little bit and then expire at this point in time, you'll be able to make the profit from this point to here. If it goes even further, all the way here, you'll be making even more on the embedded long call spread. And if it goes even further down here, then in the end, you'll be making a pretty big profit on your embedded long call spread, compared to if you just sell, your cover call at this point in time. All right, so this is the mindset and psychology difference between the traditional wheel strategy and the enhanced wheel strategy. So to put it simply, the mindset and psychology for the traditional wheel strategy is that you want the market to go up the moment you put on your cash secured put, right? Ideally, you don't want to get a sign. But for the enhanced wheel strategy, you're actually looking forward to get a sign. So you welcome the market to go down. Now, remember, when you are doing this strategy, your risk is on the downside. So that is why you want to get as much downside protection as possible. And the way to do that is with the enhanced wheel strategy, because you have the put ratio spread. Alright, next let's get into the pros and cons of the traditional wheel strategy and the enhanced wheel strategy. So the pros for the traditional wheel strategy is that you have consistent premium collection, right? So you just keep on selling the cash secured put, right? Regardless if the market goes up, goes down, get you assigned or not, you're going to receive the same premium. And it's simpler to execute because it's just one option. And then you receive more premium on the cash secured put than the put ratio spread if the stock goes up. And then you have more premium on the cover call than the cover call ratio spread if the stock doesn't go above the embedded long call spread in the cover call ratio spread. Again, I talked about all this in the other video on the enhanced cover call strategy. Now, what about the pros for the enhanced wheel strategy? So for the enhanced wheel strategy, right, you have a bigger max profit potential than the traditional wheel if assigned on both the put ratio spread and the cover call ratio spread. And the reason is because of the embedded debit spread. And because of this spread by itself, you actually have more protection on the downside, right? When you have more protection on the downside, you have a lower break-even price than the traditional wheel, as you have seen. And it's easier to exit the long stock position because of the lower break-even price. Now, what about for the cons? Now, for the traditional wheel strategy, you will have lesser profit than the enhanced wheel strategy if it's assigned, right? You're going to have lesser downside protection as well because you have a worse break-even price than the enhanced wheel strategy. And then it is harder to exit the long stock position because of a worse break-even price. Now, what about for the enhanced wheel strategy? The cons is that you have inconsistent profits, right? Because the profits is largely determined by where the market settles at expiration, right? It's not like the traditional wheel strategy where you know upfront how much you're going to make, because every time when you sell the premium for the cash secured put and the cover call, you're already going to know that's the max profit that you're going to make on it. But for the enhanced wheel strategy, it's a little bit hard to calculate. Now, there's also more decisions to make to adjust the put ratio spread, as you have seen, okay? Now, the put ratio spread doesn't make much if the stock keeps going up, as you can see in scenario 1. And the cover call ratio spread doesn't make much if the stock is below the embedded long call spread. So, as you can see, both have its pros and cons. Okay, so let's take a look at some takeaways. So, both the traditional wheel strategy and the enhanced wheel strategies are viable strategies, alright? The success of both strategies is dependent on the underlying stock. That means if you pick a stock that is not going to go up in the long term, then both strategies are going to lose you money. But if you pick a stock that is going to go up in the long term, then both strategies are going to make money. And there isn't one that is better. It comes down to what the stock does, right? If the stock continually goes up without going below the cash secured put, then the traditional wheel strategy would fare better. And if you get assigned on your cash secured put, then the enhanced wheel strategy would fare better, right? If you want more protection on the downside, then the enhanced wheel strategy would be better. And if you want consistency or premium collected, regardless of what the market do, then the traditional wheel strategy would be better. So ultimately, how do you decide which one is better? It comes down to which one you feel more comfortable with psychologically, right? If you feel that you're more afraid of the downside risk, then go with the enhanced wheel strategy. If you do not mind and you just want to maximize the profit regardless where the market goes to, then you can go for the traditional wheel strategy. Alright guys, so that's it for this video. I hope you found this video helpful, and if it has, I'd appreciate if you give me a thumbs up and also subscribe to my channel. And as always, thank you for watching. I appreciate your time, and may the options favor you.